In today's video, we'll be discussing about coffee can investing strategy, which is explained in a book named Coffee Can Investing by Saurabh Mukherjea, which was published in the year 2018. And in this book, the emphasis is put on high quality stocks with a low risk. So if you are interested to know more about this coffee can investing strategy, then stay tuned till the very end of the video. Hi everyone, I am Nidhi Manchanda, Certified Financial Planner and Head of Training, Research and Development at Fintoo, and you are watching Friday First Good series. So let us first discuss what exactly is this coffee can investing strategy, and after that we'll discuss few of the key learnings from this book. So let's start. Coffee can investing strategy is basically a strategy to invest into the stock market. And in this strategy, the emphasis on selecting 10 to 25 stocks, investing in them, and then forget about it. So it's basically like a buy and forget strategy. But in order to do this, you will have to select those 10 to 25 stocks where you'll be investing your money. And in the stock exchange, we know that there are a couple of companies that are listed. So out of those 5,000 plus companies, which are these 10 to 25 stocks that you will be investing? So there is a proper procedure to shortlist these companies. So there are a couple of filters that you need to apply as per this coffee can investing strategy. The first and the most important filter is to find out only those companies where the market capitalization is 100 crores or more. Now once you apply this filter, you will get certain companies, but still these companies will be around 1500 plus. So you still have to apply more filters to this. The second filter that you will apply after this is on revenue growth. So you need to check that in the last 10 years, which are those companies which has given a revenue growth of 10% year-on-year basis. Once you do this, the third filter that you need to apply is return on capital employed. So in the last 10 years, the return on capital employed, that is ROCE, should be at least 15%. After these three filters, you will have a couple of companies there. But again, you need to check few more things. First, that you need to check how is the brand value of that company, whether it is strong or not. Also check whether these companies have competitive advantage or not. Now once you do this, you'll be able to shortlist your 10 to 25 stocks. So you need to just invest into these companies and forget about it for at least 10 years. The author here explains that after filtering your stocks, it doesn't mean that all these stocks will give you huge returns. In fact, there will be certain stocks which will give you negative returns or some will give you average return, but still there will be few companies or few stocks which will give you huge returns. They will be more like a multi-bagger for you, and these stocks in itself will help you to create huge returns on your overall portfolio. Please note that as per the data, Coffee Can portfolio has consistently outperformed the Sensex returns. And if you also see the data, the longer you stay invested, the probability of you generating positive returns keeps on increasing. So in case you are staying invested for 10 years or longer, the probability of you generating positive returns will be almost 99.4%, which is almost close to 100%. So longer you stay invested, there are more chances that you will get good returns. Now that you have a fair idea about what coffee can investing is, let us move ahead and understand what are the key learnings from this book. The first learning is that you should do a goal-based financial planning. Have a goal in mind like child's education or retirement, and once you have this goal in mind, you need to create your portfolio accordingly, keeping the long-term horizon of your investment. Also, when you are creating a goal-based plan, you should consider inflation. So never forget the inflation part of it and how your goal amount or the cost will increase year-on-year basis, and it will definitely impact your overall portfolio. So make sure that you are considering inflation while calculating your goal amounts, and never forget that inflation has the capacity to reduce your real value of your money. So please keep in mind that consider inflation and then start planning. The second key learning here is, author explains that you should not be heavily invested in traditional investments like fixed deposits or real estate. In fact, you should have a proper diversified portfolio for yourself, and you should maintain an ideal asset allocation as per your risk profile and your age group. This is because to earn inflation beating returns, one must invest into equity markets for long term. The third key learning is that you need patience when you are investing. And the author has explained this in detail by taking a case study of Mr. Talwar, wherein he tries to time the market, and doing that he was not able to generate very high returns. In fact, he was able to generate just mere 4% returns. So what author tries to emphasize here is, don't try to time the market, but stay invested for a longer period of time. Then only you will be able to generate higher returns. Fourth key learning here is about the expenses. Author says that yes, expenses matter. Sometimes what happens that as an investor, you start investing into different investment and you just see the return part of it and you ignore how much expenses are being incurred on those investments. So if you're investing into stocks, there may be transaction fees, annual fees. Even in mutual funds, there are expense ratio and exit loads. So you need to keep in mind these expenses while you calculate your returns. So focus on net returns after deducting these expenses. That will give you a clear picture as how much returns you're generating on a year-on-year basis. And also the author says that although these expenses seems to be very small, but in a longer period of time it also compounds, and that is the reason attention needs to be paid here. Fifth key learning from this book is related to real estate. Now here the author Saurabh Mukherjea believes that real estate is a trap. Now major reason behind this is because the investment required is high, and also there is low liquidity when you would want to sell this investment. But nowadays there are more options available that you can get real estate exposure through REITs also. Another important thing that the author emphasized on the price fluctuations as well. There is no standard way of price determination when it comes to real estate. Like your stock market or gold, there is a proper mechanism where the price is determined. But here it depends upon where you are getting your real estate property, depending upon the city, the area, it differs. So it's not standardized as such. Along with this, in real estate, your expenses are also very high, like your brokerage expenses, stamp duty charges, registration. So if you add up all these things, investment into real estate becomes very costly. The last and the sixth learning is, do not ignore small cap companies. Although the risk component is high in these companies, they have the potential to give you higher returns as well if you compare it with large cap stocks. So here the author would want to give a message that if you are making your entire portfolio, you should definitely have exposure to small caps. But again, these small caps are fundamentally strong companies which has the potential to earn high returns in the future. But here we strongly suggest that if you are going for small cap companies, you should definitely consult a financial advisor before making any decision. This is because although the return potential is very high in these companies, at the same time the risk involved is also high. So there is a need to consult a financial advisor here. So now that you know what coffee can investing is, you can start creating your own coffee can portfolio. And if you need any assistance, feel free to get in touch with our finance experts who can help you create your own equity portfolio. If you find this video useful, do subscribe to our channel.